Alright, the last one we're going to look at today is one I told you to look at here. It's going to be Norton LifeLock. They just reported earnings after hours. We're going to try to make this one relatively quick because my mouth is still killing me after this wisdom teeth removal, but we're going to give it a shot. After hours up 1.5 now, after being up 2.4 in the normal trading session. This is one I was interested in looking at because I wanted to see what their business model looked like with this new transition to work from home, and I'm curious to see what they have going on. So you see they posted a very good EPS number, quarter four, non-GAAP EPS of 26 cents, beat by 10 cents, and a GAAP EPS of 23 cents, beat by 13 cents. So a very good beat on a GAAP perspective there. Just an overall EPS standpoint, very nice. Revenue declined 0.5% year over year, but you saw a $12.6 million beat on that as well. So they were expected to decline quite a bit more. Consumer reported billings growth of 3% year over year, and average revenue per user grew 3% year over year. Let's look at some of these fine details. So Norton LifeLock gave an inline EPS outlook. Consumer revenue grew 1% in constant currency. Consumer billings grew 2%. Average revenue per user grew 3%. For quarter one, they are guiding 590 to 605 million versus the consensus, which is a little bit low consensus, 615 million. And EPS is right in line, 20 cents consensus, 18 to 22 is what they're expecting. So not that exciting, all things considered, for a guidance perspective. They're a company that should have an opportunity ahead of them if you think about it. With a lot more work from home, people are going to need security, and they're buying new computers, new laptops, and Norton should be their go-to for security, you'd think. Maybe not, and I guess maybe they're not capitalizing on that market. So I really would like to hear some good words from the CEO on this, kind of explaining where this demand's going. If it's not going to them, it should be, all things considered, because people are all going to be focused about security. If you're doing business from home, you want to be secure about it. So, interesting to say. But revenue was 617 million a year ago, 614 million this year. GAAP EPS increased quite a bit, 6 cents a year ago versus 23 cents is what they just reported. So nice in that aspect. Consumer revenue up 1% year over year. Non-GAAP EPS was up 63% year over year. Nice on that aspect. So pretty nice, all things considered. So in only our second quarter as Norton LifeLock, we drove better than expected results on both top and bottom lines, which is one thing you don't even think about with this company, that they're a new company. They just IPO'd. Was it 20? When did they IPO? Well, they switched to Norton LifeLock as a combo deal and for 2 quarters. So it's weird thinking that merger is pretty recent, all things considered. Not a stock that's fared too well if you look historically either. So you saw a massive drop here in February. February. That was just an awful, ugly looking drop, which I think was their last earnings report, where they fell big time. That's crazy to think about. But if we get back to this, so Norton LifeLock's transition to a pure play company continued at a fast pace, with over 70% of standard cost removal completed within 5 months. Total stranded cost eliminated through the transition was estimated to be less than $1 billion, of which $750 million are cash costs. Pretty nice. They're saying they returned $9 billion to shareholders during the quarter, including a special dividend, a regular dividend, share repurchase, and convertible note retirement. Not a company I didn't know before looking into them that they paid a dividend, so that's pretty nice, all things considered. With $2.3 billion in cash and no debt maturities until the end of 2022, the company is well positioned to invest in expanding its portfolio to serve cyber safety needs for everyone. So guidance of 0 to 2% growth was adjusted for weak and ID analytics revenue. Not much change there, all things considered. Norton's, they declared a cash dividend of 12.5 cents per common share to be paid June 24th to all shareholders as of June 10th. nothing exciting there. I don't know. It's an interesting looking company. You see the cash positions increased quite a bit. We're looking 9 months ending. For some reason, this is a company that does 9 months ending. So, or this is really a year ending. This is weird. I don't know why they're comparing that, but it's a year ending. So, compared to a year ago, cash and cash equivalents have increased. They've got 2.1 billion. Total current assets decreased a little bit year over year, 3 billion on that aspect. Total assets of 7.7 billion, which sank quite a bit from the 15.9 they had last year. So the question is, where does that change? And some of it you'll see in liabilities, where they paid down some liabilities. Current liabilities have been reduced there. So really, they have a total liability aspect of 7.7 billion. The balance sheet is not beautiful on this company. Stockholder equity of $10 million. I mean, that's pretty well flat compared to they had 5 billion previously. So honestly, all things considered, it's not a beautiful looking balance sheet, and not really a company that I'm super interested in because of that balance sheet. I'm not saying that they're not a good company, and I think that they have a big opportunity ahead of them. It's just, I don't know, to me I feel like you'd expect a up in guidance because they should be seeing more demand for their services. So it's only kind of disappointing that you're not seeing that from them. So not a company I'm necessarily going to get into. I think valuation is quite cheap on this company, but maybe there's a reason for it. Yeah, and maybe there's a reason for this valuation to be so cheap. Now that you think about it, it's down after hours now. They pay a decent dividend. Is it going to be a consistent one with that balance sheet? I just don't know. It's hard to say. PE ratio is cheap on this company. I just don't know where that valuation falls for this company. I think it's disappointing that they did not give better guidance. If they did, this company would be taking off, no doubt, this year. This is still a company down 19% on the year. Really came from one dip down of 40% in a matter of a day, but recovery's not there quite yet because that guidance just doesn't look good. Not a company I'm going to get involved with personally. I think it might be a decent play as far as a long-term valuation play, but not one I'm currently involved in, and I hope you enjoyed, though.